Hey everyone, welcome back. It's time for another weekly update on my journey to build a high dividend portfolio and earn passive income. Part of my voice, got a little sick in the Christmas spirit, but hopefully you spent your Christmas with your family or by yourself, however way you want to spend it. Now, last week I showed you the core and satellite positions I'm focusing on. This week I want to be transparent and address the pretty big elephant in the room, judging from what you can see right here with this big pink marker. The recent market downturn. It's been a roller coaster ride for pretty much everyone, especially those leveraged like me with margin, and it's definitely impacted my portfolio too. So let's hop into that real quick. Now, the overall market downturn itself, it's kind of a reality check for most people that are over leveraged. I consider myself one of those people, but I have protection. And if you look to the top right, you can see that I have a put, and that is a form of it. Another way is to never over leverage with margin, never to use more than 70%, which is, even by my standards, really high. But besides that, overall, no one likes to see their portfolio value drop. And I'll be honest, it can be a little unnerving, but that's the reality of investing, especially in a volatile market. But here's the key things to remember about my strategy, right? I'm laser focused on those dividends, and my philosophy is I'm less worried about the short-term price swings and more interested in the consistent income stream the portfolio is designed to generate. It is kind of crazy that in the 1 month chart here, it's not even showing my full month because we haven't even had this portfolio for a full month and the dip already happened. And it seems like the recovery is also happening at the same time frame. Kind of crazy, but the overall value has taken a hit. But if you take a look in the left side, dividend payments are being received. They are coming every week after week. We're not even in the full month. If you look at the right side, you can see the satellite positions, and I'll go over that too because we have multiple new buys, a new satellite position, and the reasons why I sold a core position, and a reason why I have developed or I have a new core position in replacement. So this is exactly why I focus on high dividend paying investments overall. Even when the market is down, those dividends, number one, are still coming in. And number two, it can help cushion the blow. Because if we look at this very specifically, right here, we dropped from a near 13 grand portfolio to a 12 in the span of one FOMC meeting, right? And it just kept bleeding from here to here, going down to all the way to 7.92% specifically. Pretty large drop. Not a drop that would put me in a margin call, not even close, actually. At the time, I think I still had over 6 to 7 grand of cushion with the margin. So it would have taken this drop from to here. It would have taken that drop plus another 4 times that drop. And that can happen. There are black swan events that can happen. And to mitigate that, that is why I have this put protection that is put in place. I could go further into detail into why I have that. But to me, similar to a house, at least the way I've been taught, similar to how you buy insurance for your house, your portfolio is your house. So you should probably get insurance for it too. So that's just a little bit I have to spend. It was overall nearly $100 for this put, but it'll last me until January 31st, which is another month. And during that time, I'm definitely hoping to make way more than $100 within now till that time frame. And when that time ends, I'll probably buy another one for February. But yeah, it was pretty safe no matter what. I definitely wasn't sweating. I was able to sleep at night. So in the comments that were saying it's over leverage, number one, maybe to your standards, yes. But to mine and from my experience, especially from the previous portfolio that failed due to that mistake, I understand and fully grasp my risk tolerance now. Now, it can be tempting to panic and sell everything to like your stops and make sure that when it takes a dip, you're not losing everything. But if you sold down there at that 7% drop. Do you understand how heart-wrenching it would be to watch it go back up? And the one thing that I trust, one consistency in history beside death, taxes, is probably that the S&P will go up over time. Like, there isn't many things that are consistent. It's probably more consistent than most people's habits and lives, but the S&P itself, yes, is pretty consistent in that it will over time go up. Will there be black swan events? Yes, that is 30% drops plus even more 50% drops. But after one of those, it always goes back up. So it is a long-term game. And if you're in this, you should be in it for the long haul. We're talking years, not months, not weeks, unless you're day trading and you're probably asking to lose a lot. But in the long run, for income, this is the long haul. In fact, if you saw this downturn and you had some spare cash like I did, you saw it as an opportunity. You thought of it like a sale at your favorite shop. Your stocks are essentially on sale at that time. For me, with all my technical analysis, I saw that a lot of these satellite positions that I bought up, they were all on sale. And if you look to the left with me over here, we're going to go over what I bought in a second, but just OARC, super sale, NVIDIA, on sale, Murni, on sale, AIYY, Netflix, Tesla, Oldie is still on sale, actually, in my opinion. Misty, at the time that I bought it, was on sale. And YMAX and RDTE, YMAX is climbing back up, but these were all on sale. And if I looked at my whole thing, there was more and more and more and more on sale. So just overall, right now, I don't know if they're still considered on sale. I would have to look again. But I typically look at those whenever my dividends come to determine whether I reinvest into a new satellite position, I build a current satellite position, or what happens is it will just go to build the core positions even bigger. That's typically what happens. But since they're on sale, you could buy more shares at a lower price, potentially leading to an even higher dividend income in the future. I utilized it to set up my last foundational pillar for my core position. Now, you see that previous episode, YMAC and YMAX were together. I bought them and they were two pillars. With research and thanks to the comment section, I realized that they intertwine quite a bit. And YMAG, even though its performance is very good thus far, I do not feel that it is worth more than number one Cornerstone. And I do not feel that it is number two paying enough to be above Cornerstone. So it had to be just removed. And what I found at the time was that OARC, which is based on the ARC funds, it follows everything that I want in a core fund. It is, number one, in my technical analysis, showed that it was at a steep discount at the time. Still is, actually. Next to the ARC funds, which is an index fund. And the margin maintenance for it was pretty low, being about 30, 35. So still really low. Anything above 50 to 60, anything below 50 to 60, we're good. We're pretty much good for a core position. I prefer 25 to 30, but still fine on Robinhood. So it's in line with my core index holdings idea and the singular funds being the satellite positions. So YMAG was sold for near break even, a couple dollars shy of break even. And OARC was purchased with those sales being about $3,000. Bought it at 1078, currently 1108. So we're in profit. It doesn't matter. Growth doesn't matter with these stocks. What matters is that it pays the dividends, which it should within this week or by the end of this year. I also sold a bit of the NVIDIA shares right here. They were sold at a profit. I bought them at 22.84, which now looks like a steal at the moment, being 5% up. Again, growth doesn't matter, but it's just nice to see. I sold about $100 worth of it in order to buy that put protection. So I just used the NVIDIA satellite position, sold a bit of it. I'll probably buy more if it ever goes into discount. Is it on discount now? I'm not too sure. I would have to double check again from where I bought it. Probably not. Should be the main parts of it. Episode, you already know that $12,550 cleared. I put in a couple $100 more. I do it every week or every paycheck, so every couple of weeks. I'll put an extra couple hundred, and I am still using around 60 to 70% of my margin. Let us double check how much I'm using. 9K out of the potential 12.6. Bring out the calculator real quick. Divided by 9. Oh, sorry, wrong way. 9 divided by 12.6. I'm using about 71%. I don't want to use more. We're going to stick with that. And as you can see, my buffer is over $6,000. It's a 52.5% buffer, which means being a 52.5% decline to actually be in a margin call. So in a pretty good spot, in my opinion. If you over leveraged in a fund that had a really high margin maintenance, let's say 60 to 70%, this margin buffer could be half or even less than half. All that will be is about a 10 to 15% drop. 10 to 15% drops historically so far in the past couple decades. So all it takes is one correction. And if you're all in on a fund like that, using that much margin, congrats, you just hit a margin call. So that's another lesson you can take from there. My overall satellite positions, even though it doesn't matter with the growth, most of them are doing well. Just run them down. Like I said at the start, ORC already showed, NVIDIA showed, Moderna, it was at a discount, bought it at 5. I was willing to buy it even lower. If it kept going lower, I would buy more. It's currently at 538, expecting a drop, but pretty good. AIYY, it's currently $9.05. I bought it at 862, over 5%, near 5% returns. Netflix, $17.99. It's currently at $19.48. It's probably not at discount, but I'd have to double check. Doing 8%, very good. No complaints. Tesla, I bought it at $16.56. Wish it was back whenever it was at $15.14. I would have bought it, but dividends didn't come at the time. It was still at a discount when I got it. So we're sitting pretty over 5%. Growth, Ulti bought at $9.50. Wish I bought it when it was at 8. 9, again, dividends didn't come, but I was able to build a position and got 3% so far. Misty might be a loser. Yeah, a loser that I have. Here we go. Bought it at $31.25, which at a discount, is currently, as we're speaking, I can definitely assure you it is still at a discount based on my technical analysis. So minus 0.8%. YMAX, I nearly fully regained however much I lost from the dip nearly. At one point, I saw the total return was minus 6 to 7%. So now it being minus 1%, minus 2%, that's pretty nice. Again, reemphasize, we do not actually care what the value of these things are because we're just going to keep holding. We're just going to wait until it all pays off. And I do have an Excel sheet that shows the payments and stuff similar to how it looks over here on the, let me just pull it up, similar to how it looks over here on the left-hand side. Go to that. On the left-hand side, kind of looks like that. That spreadsheet, I made an Excel spreadsheet to just show total amount, and the total amount thus far, I can't pull up the press. I could say it out loud if I could find it. So far, I made $185.55. It's only been a couple of weeks in, and we are looking to make at least 1,000 in a month. We are far from that, but hopefully this coming year, we will have the opportunity to find more bargains, and if not find more bargains, we're never buying a premium, but we will be hunkering down and buying more of those core funds, or even developing more core funds. Who knows? You know, if it's a good enough fund that fits my criteria, I'll tell you my criteria. Number 1, has a higher dividend than Cornerstone. Number 2, margin maintenance below 30 to 35%, and has a long enough track record. But to be honest, a lot of they're speculative, so track records don't really mean much to me at the moment since I'm kind of playing with fire in that essence. Moving forward, overall, can't predict the future of the market. Go up, down, sideways, but whatever happens, I'm going to keep focusing on my strategy, reinvesting the dividends and building this portfolio week by week. It ain't about getting rich quick. Definitely ain't. It's about building sustainable long-term wealth through the power of compounding through these devices. It's a journey I'm excited to share with you every step of the way. Yeah, I think that should be about it. Thanks for joining me, everyone. Don't forget to like and subscribe. I will update on a post again, so please keep an eye out so you can see the posts of the dividends and what I'll be doing with them potentially. And I'll give you an update again next week. Again, happy Christmas. Hopefully you can reflect on the new year, because I've been reflecting a lot, and hopefully we can make this one actually work out. So I'll see you next week for the next update.